Hi there, accountants. I hope all is well, and I pray that as you are viewing this video, that you are in the best of health and spirit. This video will cover Chapter 3 from Survey of Accounting, Basic Accounting Systems, Accrual Basis. So the purpose of Chapter 3 is essentially to explore the concepts that govern accrual accounting. So as covered in Chapter 2, revenues are sometimes earned at the point where the cash is received. So in Chapter 2, we learned about the cash basis of accounting. But keep in mind, there's companies who render services, they sell a product to a customer before they actually receive the cash. Or sometimes a company, they might also incur an expense before they actually pay for it. So in this case, we take the time to go through the concepts of accrual accounting. We discuss the matching concept, revenue recognition, as well as the expense recognition principles. Then we also discuss why accrual accounting is required by GAAP. And then we also take the time to go through the quick ratio to assess a company's liquidity. So some of the learning objectives from this chapter includes describing accrual accounting concepts, including the matching concept, revenue recognition and expense recognition principles, analyzing, recording, and summarizing transactions using accrual accounting, describing and illustrating the end of period adjustment process, preparing financial statements using accrual accounting, including a classified balance sheet, describing why generally accepted accounting principles, GAAP, requires the accrual basis of accounting. And lastly, describing and illustrating the use of the quick ratio in assessing a company's liquidity. So as it relates to accrual accounting, so in the real world, we know that for businesses, sometimes the cash is received or paid at a different time from when the revenues are earned or when the expenses are incurred. So in fact, there's a lot of companies, they earn revenue before or after the cash is received, and they incur expenses before or after the cash is paid. So with accrual basis accounting, it's essentially designed to avoid misleading information that arises from the difference of timing of the cash receipts and the cash payments. So under the accrual accounting, transactions are recorded as they occur, and thus how they impact, how they affect the accounting equation. And this includes our assets, our liabilities, and our stockholders' equity, which is a component of our common stock, which represents owners' investment, dividends, which represents distributions to stockholders, our revenue, and our expenses. So under the accrual basis of accounting, revenues are recorded as they are earned, and they are matched against the revenue that they generate. So our expenses are matched in the period. Key thing to keep in mind is that transactions are recorded even though the cash is not received or it's paid until a later point in time. So there's certain principles that essentially govern when something needs to be recognized. So in accounting, the term recognize is used to refer to when a transaction is being recorded. So under the revenue recognition principle, revenue is recorded when services have been provided or when a service has been delivered to a customer. So under the revenue recognition principle, so long as the service has been provided or the product was delivered to the customer, then revenue is considered earned, therefore it needs to be recognized. Under the expense recognition principle, expenses are recorded in the same period that they generate revenue. This is required by what's called the matching concept. So the net income or net loss for the period is properly determined because the expenses that were incurred, with no regard to whether the expense incurred was paid for or not, it is reflected in the proper period to which that expense generated income. So accrual accounting also recognizes liabilities at the time that the business incurs the obligation to pay for the services or the goods that have been purchased. So we continue on with family health care and their transactions. So we utilize the integrated financial framework in order to analyze and record the transactions in the financial statement elements that are called accounts. So we know we have our basic accounts, our assets, liabilities, and stockholders' equity, which consists of the four components as discussed earlier. Then we also discuss quick assets. So quick assets includes cash and other assets that can be readily converted to cash, such as receivables and marketable securities. So this is an example of liquidity. Liquidity is essentially how fast we can turn our assets into cash. And that is how we list all of the assets on the balance sheet based on liquidity. Inventory is not normally included as a quick asset. Reason being, inventory must first be sold and any related receivable needs to be collected before it's converted to cash. So therefore, inventory is not normally considered a quick asset. So the profitability metric we'll use for family healthcare transactions is termed net income under the accrual basis. And as you can imagine, because under the cash basis, we only record revenue when it has been received in cash, and we only record expenses when the cash has been paid. So therefore, there will be a distinction depending on the nature of the company. The net income for cash basis might be different from the net income for the accrual basis. So we have these various transactions for family healthcare. So for transaction A, they received rent in advance. So on November 1st, Family Healthcare PC received $1,800 from ILS Company as rent for the use of Family Healthcare's land as a temporary parking lot from November 2000 year 5 through March 2000 year 6. So we have to take the time to reflect and realize, okay, with each transaction that takes place, does it increase or does it decrease a financial statement element? So therefore, we know that these financial statement elements are referred to as our accounts. So in this transaction, we see that Family Health entered into a rental agreement for the use of the land for 5 months, November year 5 through March year 6. So in this agreement, they require a payment of the rental fee and they're receiving it in advance. So what this simply means is that Family Healthcare, they're getting money in advance. They did not yet earn it. They're going to earn it on a month-by-month basis. So because of this, they essentially incur a liability. They need to make the land available for ILS's use. So we see the impact, obviously. We started off with a cash balance of $7,320, and then we received cash of $1,800. So now our cash balance is $9,120. So keep in mind, when money is coming into a business, it's for one of three reasons. Either we earned the income. In this case, we didn't earn anything as yet. Either our owners invested the income in the form of common stock, or we have a liability. In this case, we have a liability to our customers to provide a service. We have an obligation. So therefore, we see that there's an increase to our liability, AKA unearned revenue account, for $1,800. And then essentially what would happen is that over time, as they earn the income, then from there, it will decrease the liability and they will essentially earn the revenue. So in such case, just to get a better understanding of how this applies, we'll look at a quick calculation. So we see here, $1,800 was received. So it would be the $1,800 divided by 5 months. So therefore, each month that passes, they earn $360. So ILS could have just decided, hey, you know what, we'll pay $360 a month, but instead they decided to pay 5 months in advance. So therefore, the $1,800 paid in advance for 5 months is equivalent to $360 per month. For transaction B, States November 1st, Family Healthcare PC paid a premium of $2,400 for a 2-year general business insurance policy that covers risks from fire and theft. So by paying the premium, Family Healthcare, they essentially purchased an asset, insurance coverage for the next 2 years in exchange for cash. So the effect of this transaction on Family Healthcare's financial statements are seen as follows. So in the balance sheet columns, we have a mix of assets that have essentially changed. We have cash, now we have prepaid insurance, and we also have land. So we see that there was a decrease to our cash because anytime we see paid, we know that there is a decrease to our cash. So our balance after we've received the 1,800 from ILS increased to 9,120. And now since we just paid insurance for 2 years, the decrease is now $6,720, and we now have $2,400 worth of a prepaid asset. So prepaid insurance is a bit unique, and the reason being is because it expires with the passage of time. So in the event that Family Healthcare decided to pay on a monthly basis, they would simply pay $100 per month. We see that this is a 2-year insurance policy. There's 12 months in a year. So therefore, 12 months for year 1, 12 months for year 2, there's a total of 24 months. So if we were to break this down, $2,400 divided by 24 months, it is equivalent to $100 per month. So as each month passes, then the insurance expires on a monthly basis. A great example of this in our everyday life would essentially be a car insurance premium. So for the most part, certain car insurance companies, they will give you a discount on your rate if you pay in advance. So generally, most persons, they will pay for a 6-month premium in advance or a year premium in advance, thus taking advantage of the discount. And let's just use Geico for an example. If you pay Geico $600 for car insurance, and just to make it easy, let's say it's $100 per month. If you pay the $600 on January 1st of the year, you don't expect that Geico will call you March 31st saying, hey, you need to pay for the month of April. You paid 6 months in advance, therefore Geico has an obligation to provide you with insurance coverage. And this brings us to transaction C. So here it states November 1st, Family Healthcare PC paid $6,000 for an insurance premium on a 6-month medical malpractice policy. So this is similar to the preceding transaction. So in the previous transaction, we had insurance policy that covers from fire and theft. In this example, we have a premium on a 6-month medical malpractice policy. So similar. In this case, we see that we have prepaid insurance of $6,000. And then we know that we paid cash, so therefore there's a decrease to our cash. For transaction D, we have an additional capital investment. So Dr. Landry, who's the owner, the stockholder, invested an additional $5,000 in the business in exchange for common stock. So as mentioned, there's 3 reasons for which money is coming into the business. Either it was invested by the owners in the form of common stock, the business earned it in the form of revenue, or there is a liability that has been incurred. And in this case, $5,000 cash was received by the stockholder. So there's an increase to our cash and there's an increase to the balance in the common stock account. Transaction E, we purchases on account. So Family Healthcare PC purchased supplies for $240 on account. So this transaction is a bit similar to transactions B and C in that purchase supplies are assets until they're actually used up in a generation of revenue. So Family Healthcare, they purchased and they received supplies with the promise to pay in the future. So in such case, there's a liability that has been incurred, and this is called accounts payable. So in this case, we see we have supplies. We're prepaying for the supplies that will be used in the business. So we have an increase to our asset for $240. And we have an obligation to pay the vendor $240. So there's an increase to our asset and an increase in liability. For transaction F, purchase of equipment, Family Healthcare PC purchased $8,500 of office equipment. They paid $1,700 cash as a down payment, with the remaining $6,800 due in 5 monthly installments of $1,360 beginning January 1st, 2006. So in this transaction, the asset office equipment increases by $8,500. But here we see a bit of a nuance with the transaction. There's a decrease to cash of $1,700, and there's also an increase of a liability of $6,800. So in this case, cash was paid, and we also have a liability. So we increase the value in our office equipment account by $8,500. The balance in our cash account decreases by $1,700, and our notes payable increases by $6,800. Transaction G, services provided on account. Family Healthcare PC provided services of $6,100 to patients on account. So in this case, this transaction is similar to the revenue transactions that were recorded for family healthcare in September and October. But one key difference is that in September and October, they received cash. But in this case, the services were provided on account. So what this simply means is that family healthcare is going to collect the cash from the patient's insurance company in the future. So any amounts that are expected to be collected in the future that arise from normal operations are called accounts receivable. So the company is expecting to receive this income in the future, this cash in the future. So this creates a valid claim for the company. Hey, family healthcare provided the service. We are expecting to receive payment. So since a valid claim exists for the future collection, accounts receivable is an asset. So here we see an increase to our accounts receivable of $6,100, and our retained earnings, our revenue, is increased because we earned the income. So under the cash basis method of accounting, nothing would be recorded because we did not receive the income in cash. However, under the accrual method of accounting, it does not matter if you receive the cash in advance or if you receive the cash after you've provided the service. The key thing is, did you earn the income? And in this case, they did. Transaction H, services provided for cash. So this transaction is similar, again, to the transactions that we've recorded in September and October. We're receiving cash, so therefore there's an increase to our cash account of $5,500, and there's another increase to our retained earnings of $5,500. Transaction I, collection of accounts receivable. So Family Healthcare PC received $4,200 from insurance companies that paid on patients' accounts for services that have been provided. So in this case, we are now receiving the cash for services that were provided before. So as we see here, cash is increased because cash is coming into the business, and we see our accounts receivable is now decreasing. Originally, our customers owed us $6,100. We're receiving payment from the insurance company of $4,200. So now the balance that is due from our customers is $1,900. Transaction J, accounts payable. Family Healthcare PC paid $100 on account for supplies that had been purchased. So the cash was paid for supplies that were purchased on account. So therefore, with this transaction, we see paid. So obviously there's a decrease to cash, and it would be a decrease to our liability. Initially, we had a liability of $240 for the supplies that were purchased. And now we are paying $100 towards the money, the debt, the obligation that we have to the vendor. So now we went from owing the vendor $240 to $140. Transaction K, expenses paid in cash. Family Healthcare PC paid expenses during November as follows: wages, $2,790, rent of $800, utilities of $580, interest of $100, and miscellaneous expenses of $420. So in total, we have 5 expenses: wages, rent, utilities, interest, and miscellaneous expenses. So as we know, our expenses represent a decrease to our retained earnings. So therefore, we have a decrease to our retained earnings of $4,690 for the expenses that have been paid. So therefore, there is a decrease to our cash account of $4,690. Here we see transaction L, dividends paid in cash. So this transaction is similar to Family Healthcare's dividend transaction in both September and October. So the effects of this transaction is as follows. We see paid, so we know that there's going to be a decrease to our cash account. And then dividends represents a decrease to our retained earnings. Dividends essentially represent distributions to our stockholders, our shareholders, and dividends are paid from retained earnings. And retained earnings is our revenue minus our expenses. So that brings us to all of the transactions that we, incurred for the period. So we had transaction A through transaction L. So now as we go through the accrual accounting, we need to recognize that there's an adjustment process that needs to take place. So accrual accounting requires the updating of the accounting records prior to preparing the financial statements. This is known as the adjustment process. And the reason why this is necessary is because you need to match revenues and expenses, which is the application of the matching concept and the revenue and expense recognition principles. The adjustments are necessary because at any point in time, some accounts, elements of the accounting equation, they may or may not be up to date. So therefore, we need to go through the adjusting process to ensure that all of the accounts, the elements, the balances in these accounts are up to date. So this brings us to what's called accruals and deferrals. So the types of accounts that require adjustments are as follows. We have what's called deferrals, and these are created by recording a transaction in a way that delays or defers. Another, concept when you think of defer, it's essentially to postpone. So it's created by recording a transaction in a way that delays or defers the recognition of an expense or revenue. Next, we have accruals. Accruals are created when a revenue or expense has been earned or incurred, but it has not yet been recorded. So some common deferrals include prepaid expenses and unearned revenue. So prepaid expense or deferred expenses are initially recorded as assets, but they become expenses over time through normal operations of the business. So a great example of a prepaid or deferred expense would be when Family Healthcare paid $2,400 rather for an insurance policy. So they're paying for it in advance. And over the 2-year period, each month that passes, it is being used up. You would record the insurance expense for $100 for each month. So that would be an example of a prepaid expense. Next, we have unearned revenues or deferred revenues. And these are initially recorded as liabilities, but they become revenue over time through normal operations of the business. So example of this would be family health care. They received $1,800 from ILS Inc. to make the land available for 5 months. So therefore, they received this $1,800 in advance, which is the equivalent to $360 per month. So at the end of each month, family health care is earning the income, but because they were paid in advance, it is a deferred revenue. They cannot recognize it as revenue because based on the revenue recognition principle, revenue cannot be recognized unless it has been earned. So next, as we look at our accruals, common accruals include accrued expenses and accrued revenues. Accrued expenses or accrued liabilities are expenses that have been incurred but are not recorded in the accounts. So an example of this would be, let's say family healthcare received a bill for utilities, let's say for the water bill, it was $200. So in such case, they've used up the utility. So they would recognize the utility expense. And in this case, because they did not pay for it, there is a liability to pay the utility company going forward. So therefore, this is an example of an accrued expense. They've used up the water bill. They incurred the expense. However, they have not yet paid it. So there is a liability. Next, we have accrued revenues or accrued assets. And these are revenues that have been earned but are not yet recorded in the accounts. So example of this would be that we've provided a service to a customer. However, we have not yet received payment from the insurance company. So therefore, we have an accounts receivable because we are expecting to receive the cash in the future. And then we would credit our revenue because in this case, we did earn the revenue, we provided the service. So deferrals are normally the result of cash that's received or paid before the revenue is earned, and expenses that are paid for before the expenses actually incurred. And in comparison, accruals are normally the result of cash that's received or paid after the revenue has been earned. Therefore, we have an accounts receivable, or after an expense has been incurred. Therefore, we have an payable. So this is essentially an example, an exhibit of deferrals and accruals. So here we see with the current accounting period, with deferrals, the cash is received or paid in advance, and then the revenue is earned or the expenses incurred in the future period. So we see here in the current period, we receive the cash, and then the revenue would be earned or the expense incurred in the future period. And then when we're dealing with accruals, the revenue is earned or the expenses incurred in the current period, and the cash is going to be received or paid in a future accounting period. So it's very important to distinguish between deferrals and accruals. So with our first adjustment, this prepaid insurance that expired. So we paid for our insurance in advance, and then now it has expired. So therefore, during November, a portion of the prepaid insurance that was purchased on November 1st expired. So therefore, we have to account for the two policies that they paid for. So we know that they had a general business policy of $2,400, which was from transaction B. And then there was a malpractice policy for $6,000, which was from transaction C. So the general business policy was a 2-year policy that expired at a rate of $100 per month, 2,400 divided by 24 months. And the malpractice policy was a 6-month policy that expired at a rate of $1,000, $6,000 divided by 6 months. So therefore, a total of $1,100 of prepaid insurance expired by the end of November. So therefore, in order for us to account for the elements that are impacted, we know that the balance in our prepaid insurance account is going to decrease. $1,000 decreasing for the malpractice policy, and $100 for the general business policy. So therefore, there's a decrease to our prepaid insurance account, and it is now $7,300. And we recognize the expense under our retained earnings. So therefore, we would recognize insurance expense of $1,100 with a debit, and we would credit our prepaid insurance asset account to decrease the balance in the account. For adjustment A2, the supplies used. So in such case, it lets us know that we've used $150 worth of supplies. So we started off with 240 supplies, and now we only have 90 left because we've used up 150. So therefore, we would debit our supplies expense account, because again, expenses represent assets that have been used up or services that have been consumed. And in this case, it is the asset that has been used up, our supplies expense. So we would debit supplies expense for $150, and we would credit our supplies asset account to decrease the balance in that account. We started off with 250. We've used $150. So therefore, the balance in our supplies account is 90. So this brings us to another type of adjustment that needs to take place, and it's called depreciation. So long-term assets such as office equipment, they lose their ability to provide service over time. So this reduction in the ability of an asset to provide service is called depreciation. So if you go out right now and you purchase a computer, with usage of the computer, it declines, because the ability, to run and to function, when you first get the computer, the speed is fast, but over time, the speed of the asset, it loses its ability to provide service. In this case, the computer, but in this example, the office equipment. So it's essentially difficult to, objectively determine the physical decline in assets' ability to provide service. So for this reason, we use depreciation. And depreciation is estimated based on the asset's useful life. And there's several methods of estimating depreciation. So Family Healthcare's office equipment depreciation for November is $160. The fixed asset account is not reduced directly for depreciation. Instead, we have an offsetting or contra asset account called depreciation. Just a few things to keep in mind. Land is not depreciated because it does not lose its ability to provide service. Oftentimes, you might be in your local neighborhood, and in 1 minute, it might be a restaurant. Then the restaurant, shifts to a clothing store. Then the clothing store shifts to another store. So land can always provide value. So therefore, land is not depreciated. The cost of equipment is a type of deferred expense that is recognized as an expense over the fixed asset's useful life. The cost of the fixed asset less the balance of its accumulated depreciation is called the asset's book value or carrying value. So this is our depreciation adjustment. The depreciation on the office equipment of $160. So as mentioned, the office equipment, the value of $8,500 remains on the books. We do not adjust it, but we have this contra account. So just keep in mind with contra accounts, it essentially is an asset account, but the key thing is that it has a normal balance that is the opposite. So sometimes we have contra liability accounts, contra asset accounts, and it essentially separately records information that offsets an asset or liability account. So in this case, if we, look at the office equipment, we see it's $8,500, but we see that we've taken depreciation. So the carrying value, the book value in this case would be $8,340, and which is simply the $8,500 minus $160. So for adjustment A4, unearned revenue earned. So we know that ILS paid Family Healthcare $1,800 in advance to utilize their land for 5 months. So if we divide the 1,800 by 5, family health care earns $360 per month. So at the end of the month, we need to make an adjustment. So therefore, our liability decreases. We see that there's a decrease to our unearned revenue of $360. Our liability decreases. And there's an increase to our retained earnings because we can now recognize the revenue because it was. Adjustment A5, wages owed. Wages owed, but not yet paid to employees. So we incurred the expense, but we have not yet paid it. So this is an example of an accrued expense. So we would debit our wages expense, and we would credit our wages payable. We have a liability and obligation to pay our employees. Adjustment A6, services have been provided but not billed to insurance companies for $750. So we provided the service, but we have not yet earned it. So in such case, we will have an accounts receivable, an increase of $750 our customers owe us, and we provided the service. So even though we have not yet received the cash, we've earned it. So based on the revenue recognition principle, we need to record the increase of revenue, which has an impact on our retained earnings. So based on a summary of transactions and adjustments that we just saw, family healthcare, we essentially see everything that's taken place. So the income statement is prepared by summarizing the revenue and expense transactions. So revenues are a result of providing services or selling products to a customer. Revenues from the primary operations of the business are reported separately from other revenue. We want to be able to see what is our operating income. Expenses are assets that are used up or services that are consumed in the process of generating revenue. Expenses are matched against their related revenues in order to determine the net income or the net loss for the period. For our statement of stockholders' equity, it's prepared by first adding any common stock that was issued to the beginning balance of the common stock. From there, the net income is added to retained earnings. And if there was a net loss, the net loss would be subtracted from retained earnings. Dividends are subtracted from retained earnings, and the adjusted common stock and retained earnings balances equal the ending balance of stockholders' equity at the end of the reporting period. So this just ties into why there's a specific sequence in which the financial statements must be prepared. We start off with our income statement. From there, we prepare our statement of stockholders' equity. Then from there, we prepare our balance sheet. And lastly, our statement of cash flows. So our classified balance sheet is prepared with various sections, subsections, and captions. So we have what's called current assets, fixed assets, and intangible assets. So current assets are cash and other assets that are expected to be converted to cash or sold and used up within 1 year or less through normal operations. So in addition, this includes current assets such as accounts receivable, notes receivable, supplies, and prepaid expenses. Next, we have fixed assets. And fixed assets are physical assets of a long-term nature and may also be reported on a balance sheet as property, plant, and equipment or plant assets. So property, plant, and equipment asset, it can include equipment, machinery, buildings, and land. So except for land, property, plant, and equipment assets, they depreciate over a period of time. And the cost less the accumulated depreciation for each major type of asset is normally reported on the classified balance sheet. And then lastly, we have what are called intangible assets. And these represent rights of a long-term nature, such as patents, rights, copyrights, and goodwills. So goodwill, that arises from such factors as brand recognition, location, the quality of a product, reputation, the skill of the managers. So goodwill that is recorded and reported on a balance sheet whenever a company purchases another company at a price above the normal market value. And one key thing to keep in mind is that with intangible assets, you cannot perceive them with your five senses. You cannot see, touch, taste, feel, etc. intangible assets. So that is in comparison to our tangible assets. We can see our machinery, we can see our equipment and touch it. So you must be able to understand that there's a difference between tangible, those that we can see and perceive with our five senses, versus intangible assets, which are those assets that we cannot perceive with our five senses. However, they have value. A classified balance sheet normally reports liabilities as current liabilities and long-term liabilities. So our current liabilities are due within a short time, usually 1 year or less, and they're to be paid out of current assets. So some common current liabilities include accounts payable, notes payable, and some other current liabilities would be wages payable, interest payable, tax payable, as well as unearned revenue. Next, we have long-term liabilities, and these are not due for a long time. It's usually more than 1 year. So long-term liabilities are reported following the current year. So a great example of long-term liabilities would be like a mortgage note payable. So a classified balance sheet normally reports stockholders' equity as common stock and retained earnings, which we know is a component of revenue minus expenses. And if the company has a net income, then dividends has a decreasing effect on retained earnings. And for the statement of cash flows, it classifies cash transactions as operating, investing, or financing. So revenues are a result of providing services or selling products to customers. So revenues from the primary operations of the business are reported separately from other income. So in this case, for family healthcare's operating activity, any cash receipts from revenue transactions are added, and any cash payments for operating transactions are subtracted to determine cash flows for operating activities. Any investing activities, this is the cash payment for office equipment that will be subtracted to determine the cash flows from investing activities. And the financing activities, the cash payment or cash receipt rather for additional investment is added, and the cash payment for dividends is subtracted to determine the cash flows from financing activities. So here we essentially see in Exhibit 2, this is just an overarching view of all of the transactions that have taken place, transactions A through L, and then our adjusting entries A1 through A6. And then from here, we see the impact of what took place on the statement of cash flow. Some of them are classified as operating activities, those that impact the normal day-to-day operations, investing, and then we also see financing. And then we also see to the far right, our income statement, our revenue, our fees earned, minus all of our expenses. And for Exhibit 3, we essentially start to look at, the metric, the effects of the transactions that have taken place. And we have liquidity, and this considers our quick assets and then our profitability based on the net income accrual basis. So for Exhibit 4, we see here the income statement for the period after we consider all fees earned minus all of the expenses. We have a net income of $6,390. And keep in mind, we know that the financial statements are integrated. So we start off with our income statement. There's net income of $6,390. Next, we prepare our statement of stockholders' equity, and we have an increase for our net income. And we paid out dividends of $1,200. So our ending retained earnings balance is $8,510. We started off with a common stock balance of $6,000, and the stockholder made an additional $5,000 contribution. So our beginning balance for common stock was $6,000. The ending balance is $11,000. The beginning balance for our retained earnings was $3,320, and our ending balance is $8,510. So our total stockholders' equity beginning balance was $9,320. And now our ending balance is $19,510. So the significance of this is that when we prepare our balance sheet, we bring over all of the information, our current assets, and then for our stockholders' equity, we copy the ending balances that was calculated. So our common stock ending balance of $11,000 and our retained earnings ending balance of $8,510. And next we have our statement of cash flows. So we see the cash as of November 30th. This will match the cash balance on the balance sheet. So here we see our assets, the cash is reflected with the ending balance here of $7,730. And then we have our income statement, our net income, which has an impact on the statement of stockholders' equity. And then our ending balances for the statement of stockholders' equity then transfers to our balance sheet. So the accrual basis of accounting was used in this chapter to record Family Healthcare's November transactions. So the accrual basis of accounting, it's required by GAAP, generally accepted accounting principles, and is generally used by large corporations whose stock is publicly traded. And it's important to understand why the accrual basis of accounting is required by GAAP. It's essential to be able to know how to analyze and evaluate financial statements. So to understand why accrual, basis is required, it's first necessary to consider the alternative, right? So in chapters 1 and 2, Family Healthcare recorded all of the transactions based on cash basis. So this is the primary alternative to GAAP, the cash basis of accounting. And this is when you only record transactions based on when cash is received or when cash is paid. So for example, let's say, revenue is recorded when cash is received from a customer, regardless of when the services or goods have been provided or delivered. And likewise, expenses are recorded when the cash is paid, with no regard to when the related revenues are recorded. So in such case, revenues and expenses are reported in the income statement when the cash is received. So one of the challenges with this is that, again, it can be a bit misleading. So accrual basis better reports the underlying operating performance of Family Healthcare's November operations, because again, we think back to the revenue recognition principle and the expense recognition principle with the matching concept. So this is why accrual accounting is required by GAAP. So this is an example of what the difference would be. So if we were using the accrual basis of accounting, in November, income would be $12,710, and operating expenses would be $6,320 for net income of $6,390. But if we compare it to November, revenue would be $11,500 and operating expenses would be $13,190. So there would be a net loss under the cash basis of accounting of $1,690. In October, the accrual basis and cash basis method of accounting is the same because there were no accrual transactions or deferred transactions. Everything was essentially recorded based on cash received and cash paid. There were only cash transactions in October, but in November, things were a little different. They provided services on account and they purchased items on account and paid for items in advance, as well as received income payment in advance. So we see that there's a key distinction between the accrual basis of accounting and the cash basis of accounting. So it's important to, understand the difference between cash versus accrual accounting. So recorded requirements are as follows. Revenue is recorded, expenses recorded, adjusting entry. So under the cash basis, revenue is recorded when cash is received. That's the main thing. When we receive cash, we record the revenue. Under the cash basis, expenses are recorded when the cash is paid. And adjusting entries are not required because, again, we only care about when cash is being received. Under the accrual basis, however, revenue is recorded. It's recognized when the revenue has been earned. So the key thing is, did we provide the service? Did we deliver the product to the customer? If the answer is yes, then we must record, we must recognize the revenue. As it relates to the expenses, was the expense incurred assisting in generating revenue? Did our employees work for us? Did we use up the water? Did we utilize the lighting system? So anytime we essentially use up or we incur the expense, it needs to be recorded. So just a key reminder, expenses are assets that have been used up or services consumed in the process of generating revenue. And our expenses follow the matching concept. Therefore, they need to be matched against the related revenue to determine the net income or net loss for the period. And under the accrual basis, we record adjusting entries, and they are required in order to prepare our financial statements. So the accounting cycle is essentially the process that begins with analyzing transactions. There are some steps in between, and the end result is preparing the financial statements. So by using the integrated financial statement framework, the accounting cycle for the cash basis of accounting consists of two steps. The first is to identify, analyze, and record the effects of each cash transaction on the balance sheet, statement of cash flows, and income statement. And then we prepare the financial statements. However, under the accrual basis of accounting, there's three steps. The first is that using the matching concept, including the revenue and expense recognition principles, we identify, analyze, and record the effects of each transaction on the balance sheet, statement of cash flows, and income statement. We assemble any adjustment data and record end of period adjustments, and then we prepare the financial statements. So for a metric-based analysis, this is an important aspect of a company's financial condition. You want to be able to determine what is the company's ability to pay their short-term liabilities as they become due. So we have this metric, a liquidity metric, quick assets, and it measures the amount of cash and other assets that a company has on hand to pay their current liabilities. So the quick ratio is a related metric used to assess a company's ability to pay its current liabilities. The quick ratio is computed as quick assets divided by current liabilities. So the quick ratio is a better metric than, looking at quick assets, because imagine if we are dealing with different companies, right? One might be a Fortune 500 company, the other might be a small, company. And if we're looking at numbers, the large Fortune 500 company, their numbers might be in the millions. The smaller company, mid-sized company might be in the 100,000s. So by using a ratio, it essentially eliminates the effect of size differences among companies. So here we have an example. We have Fly Creek Company and we have Huron Inc. So here we see in this example, Fly Creek has $180,000 of quick assets compared to Huron's, they have $720,000, right? And how do we calculate that? Cash and accounts receivable. So Fly Creek, that is how we calculate the 180,000 versus Huron, which has $720,000. So in this case, Huron has 4 times the amount of quick assets as Fly Creek. So on the surface, it might appear that they have a stronger liquidity position, but as we start to look at the ratio, we'll see that that's actually not true. So here, in order to calculate the quick ratio, again, we divide the quick assets by the current liability. So in this case, for Fly Creek, it's 60,000 plus 120,000, which gives us a numerator of 180,000 divided by 150,000. The quick ratio for Fly Creek is 1.2 versus Huron Inc. The quick ratio is 120,000 plus 600,000, which gives us a numerator of 720,000, and the denominator is 800,000, and Huron's quick ratio is 0.9%. So as we see here, the quick ratio indicates that Fly Creek actually has a stronger liquidity position as compared to Huron Inc. Huron's quick ratio is less than 1.0, and this basically raises concerns as to whether or not they'll be able to pay their current liabilities on time. So although quick ratio, it can vary by industry, a quick ratio of at least 1 is normal. And anytime a quick ratio of less than 1, such as Huron Inc.'s ratio of 0.9, it can essentially raise liquidity concerns for creditors. So that brings us to the end of the presentation for Chapter 3, Basic Accounting Systems. So by going through these PowerPoints, you should have learned how to describe accrual accounting concepts, including the matching concept, revenue recognition, which means that you record revenue when it has been earned with no regard to when the cash is received, and the expense recognition principle, which means that expenses are matched against their related revenues to determine the net income or net loss for the period. Analyze, record, and summarize transactions using accrual accounting. So as we learned, accrual accounting is essentially important because it helps to minimize any misleading information that arises from the timing of cash payments and cash receipts. Because again, the cash payment and cash payment can be before or after the transaction takes place. We described and illustrated the end of period adjustment process. We prepared financial statements using accrual accounting, including a classified balance sheet. We described why generally accepted accounting principles require the accrual basis of accounting. And we described and illustrated the use of the quick ratio in assessing a company's liquidity.